Hey guys, welcome back to my channel. In this video, we will be going through our RSI indicator trading strategy in depth and how can we use it in combination with price action. Guys, thank you all for the continued support. And you want more videos more often, so please smash the like button, subscribe and turn on the notification bell so that you know exactly when new content is released. So guys, one important point before we start. Indicators are not magic. We never use indicators in their own for trade entries. We use indicators to support what have already established with price action. Advanced price action. In this video, we go through advanced price action and the RSI to take your trading to the next level. So strap in as we are going deep. So here the quick breakdown of what we will be covering. First, what we will be go through all core concept of RSI first to 6th section, and we'll go through strategy section after that. Okay, so strap in as we have a lot of cover today, so let's get into it. What is the RSI indicator? RSI stands for Relative Strength Index. It's an indicator that you apply to your charts that is often used to identify oversold and overbought markets. So guys, here the Zerodha platform. So let's apply on chart in Zerodha. We will open the chart randomly. It's a Reliance chart, okay? So and see indicators at the top here. Click indicator. Just type R and it will show up the right here. Now click the relative strength index and then it will be applied to your charts along the bottom. Okay guys, it's so simple, right? Okay, this is the Bajaj Auto chart. This line is 70 on the RSI. At or above 70 means overbought. So we can consider the overbought region. This is the 30 RSI line. At or below 30 means oversold. So it's considered as oversold region. So this line is 70 on RSI. In relative terms, when RSI line touches the 30, just like it is right here, it indicates that the price of the assets you are looking at is cheap. And same way, the RSI touches the 70, just like it right here, it indicates price is expensive. So how is the RSI traditionally used? We cover how is the RSI traditionally used. Second one, most of traders do when the RSI enters oversold region, they start buying and make a long positions and expect the price will go up. And in same way, RSI enters overbought region, they start selling and make a short position and expect the price will go down. But here the problem using the RSI like this. You can see here RSI has already at oversold region, and you make the decision and started entering long position, and price would have continued to against you for some time before it finally reversed. So what this means is heavily trending market. Heavily trading market, RSI indicators can stay inside of the overbought or oversold region for a long time. And if you keep taking trades solely based on the RSI indicator, expecting price to reverse, you will most likely rack up a significance of losses. So, how do we use RSI indicator when it actually helps overall analysis? Guys, also right now comment below and tell us what video topics you want us to cover, as we always look at the comments to decide what to create. We use the RSI in one way only, which is combining RSI with divergence of RSI divergence. So this was third topic. So what is the divergence? Divergence occurs when price is moving in the opposite direction of the RSI indicator, which can then be used as an early indication of a possible trend change. Okay, so this is the Maruti chart. Okay, so this is the uptrend. Here you can see here price make higher highs, but on the RSI makes a lower high and resulted in a reversal of price following by RSI divergence. So going the opposite direction in this downtrend, price make a lower low, whereas the RSI made higher low, which created a divergence in a reversal of price. Now, divergence can be used in many others indicators as well. One of which MACD, which is a popular amongst many traders. So, we will cover RSI over MACD. So this then led us to another question. We often get asked, which is why we do prefer to use the RSI indicator over MACD. Okay, so this is the Maruti chart again, and now the reason is simple. It is because the RSI indicators gives us a more precise and clear divergence formation, which results is higher quality trade entries. Here is the exact same chart on both sides. On the bottom, you can see MACD indicator applied, and on the middle you can see RSI indicator applied. On the RSI here, it gives a very clear divergence formation. But now, if you look MACD, there is not a divergence signal, and this is the issue we often experienced with the MACD, which is lack of the low quality divergence signals. Okay guys, so let me clear you. There is no right or wrong choice. Both works perfectly fine. I just prefer the RSI. So now that being said, if you know how to use divergence correctly, it's one of most powerful tools for spotting and confirming high quality reversal trades. You will soon find out why. Let's cover the type of divergence we look for. Now, there are many kind of divergence people use, but here are the main two types that we look for as a part of our RSI strategy. First is a wide divergence, and second is a tight divergence. So we will cover type of divergence, and under each type there are two subtypes. Subtype 1 is when the divergence occur at or inside of overbought and oversold region, and subtype 2 is when the divergence occur close to the overbought or oversold region but doesn't touch. So let's go first type, which is the wide divergence. Okay, so wide divergence is exactly what the name states. It is a divergence where its swings are very wide and very obvious to spot on the chart. Here is the downtrend. We had our divergence, which then triggered a reversal. Notice how wide these swings are. Hence, the name wide divergence. So, how do wide divergence relate to price action? Wide divergence is also what we call high quality divergence, because we like to see wide swing and price moving sideways before looking for any kind of reversal trade, because it tells us that the side in control of the dominant trades before the reversal is no longer in complete control, hence causing the wide swings in both directions. Now again, there are two subtypes of divergence. This is the Escort chart, which is one when the divergence occurs at or inside of overbought or oversold region. You can see here. And number 2, when the divergence occurs close to the overbought or oversold region. But notice how it's close but not touching. So, moving on the second type of divergence, which is the tight divergence, which is exactly that is divergence where the swings are tight or very close together. So this is the HDFC chart. Okay, so here is your downtrend. We had our divergence before reversal occurred, but Notice how the swings are very tight, hence the name tight divergence. Now, in this example of type of divergence, you can still see the swings of price, but sometimes with tight divergence is not an easy to see, especially to the untrained eye. So again, we have the two subtypes of tight divergence, which is one, when the divergence occurs at or inside of the overbought and oversold region, and number two, when the divergence occurs close to overbought or oversold region, as same as learned in wide divergence. So guys, here is our divergence hierarchy. Now, all divergence is good, but just use this hierarchy to rank the quality of the divergence in the trade you are looking at. So go through the divergence hierarchy. So let's keep building on this and move on the next section, which is combining divergence with confirmation. This sixth section. So divergence combined with confirmation means you look for price action after the divergence occurs to confirm that the reversal is real and not a fake out. So let's break this down. Okay, guys. So this is the Hero Honda chart. This is the clear moving uptrend as price making higher highs and higher lows. So understand, run, pull back, run, pull back, run, pull back, run. So you then spot clear wide divergence formation in price, but it is not confirmed because it can start as a divergence, pull back slightly and still continue on, and then you would have been faked out and took loss. Don't forget that you are trading counter trend, so RSI divergence is not enough, and entering just from an RSI divergence signal would be guessing based off an indicator. So what you need to do this, combine RSI divergence with price action after it occurs in order to confirm that the reversal is real. Now there are many price action strategies we use in combination with divergence, but to keep things simple for this video, on great way to do this is to apply a dynamic trend line onto the immediate trend. Then you wait for the breakthrough and trend line to occur, which then confirms the divergence and confirm the reversal as a bonus. This breakdown also made a lower low, and this point is when you go to the lower time frame and start looking for short entries, so you can use the same concept for tight divergence also. So divergence combined with confirmation is only the base concept. We do not enter trades simply off these two factors. I don't make this video lengthy, so we will learn on to the actual strategy section of this video in part 2. So guys, I need your feedback right now. Do you like this video? Tell us right now in the comment if you want me to continue to release more contents more often. We need you to smash the like button and click the subscribe button and turn the notification bell, and I still have a lot of topics to cover. So thanks for watching, and I will see you in the next.